Stop scrolling, because the silver story you think you understand is about to get flipped on its head. We've got metal prices sprinting like they're late for a flight, and at the exact same time, the companies that pull that metal out of the ground are acting like they missed the memo. That mismatch is not normal. And when you see something that is not normal in a market, this emotional, it usually means something is building under the surface. Quick favor before we go any further. I'm running a campaign to eliminate copycat channels. If you value what I do here, hit subscribe and comment urgenag so the algorithm knows who the original is. Alright, here's what we're doing today. I'm going to walk you through the strange divorce happening between physical metals and mining shares, why it matters, what the tells inside the plumbing are signaling, and what could trigger the kind of overnight move that makes people stare at their phones like they just saw a ghost. And I'm not talking about a cute little pop. I am talking about the kind of price jump where headlines lag behind reality and the crowd realizes the game changed while they were asleep. Now, I brought in someone who's been watching this sector for a very long time, not a hype artist, not a guy who discovered silver last week, a veteran who lives in the numbers and watches the market's micro-behavior like a detective watches body language. I asked him a simple question. If silver is ripping, why don't the miners look like they're riding a rocket? He didn't hesitate. He said, because the leverage is gone, and that one sentence should bother you, because in a normal bull run, miners aren't supposed to politely follow the metal. Let me put that leverage idea into plain math, because once you see it, you can't unsee it. Imagine a miner that produces silver at a certain all-in cost. If silver sells for a little above that cost, the company survives, but it's not printing money. Now push the silver price higher. The cost doesn't double overnight, but revenue per ounce can. That means profit per ounce can expand faster than the metal price itself. That's why, in most cycles, miners behave like the metal with a megaphone. That's also why miners are supposed to be messy on the way up. They rip, they dump, they rip again. They don't politely track, they exaggerate. So when the metal is acting like a blowtorch and the miners are acting like damp wood, you have to ask what changed. Is it the cost structure? Is it the financing environment? Or is it the market structure itself? Because here's the part most people miss: mining stocks don't trade in a vacuum. They trade inside a giant machine of funds, baskets, and algorithmic flows. A lot of buying and selling has nothing to do with whether a company had a great quarter or found a new deposit. It's risk on, risk off, it's volatility targeting. It's index rebalancing, it's people de-risking equities when their bond book gets hit. And when that machine decides no more small cap risk today, miners get punished even if their fundamentals are improving by the hour. That's why I'm not interested in one-day moves. I'm interested in whether the machine is suppressing the whole complex. And if you're wondering why I keep saying machine, it's because you can literally watch it in the timing. The selling hits at the same windows. The recovery happens the same way. It's like someone is trying to keep the chart from looking too exciting. Now here's the cliffhanger. When charts are forced to behave, they eventually snap back with interest. The market doesn't forget pressure, it stores it. And stored pressure is what creates the days that nobody believes until they are staring at the candles in disbelief. He said, late is one thing, handcuffed is another, because what we're seeing isn't a normal lag, it's a pattern. Here's the pattern: futures can be screaming higher in the early part of the day, the kind of move that should have mining shares gapping up at the open, and then, right before the equity market opens, the metal price gets shoved down just enough to kill the excitement. The stocks open weak, they start in a hole, then they spend the whole day crawling out of that hole like it's quicksand. And if you watch it enough times, you stop calling it coincidence. Now let me be careful here. Markets are complex. There are a bunch of reasons miners can underperform even when the metal is strong. I'm not going to insult your intelligence and pretend it can only be one thing. So let's cover the boring explanations first. Because if we're going to claim the deck is stacked, we have to check the simple stuff. Plenty of miners have issued shares like crazy over the years, so even when the business improves, your ownership slice can quietly shrink. Costs are another problem. Diesel, labor, explosives, parts, freight, and permits don't stay put, and in an inflationary world, investors assume expenses creep up right behind revenue. Then there's jurisdiction risk. These companies dig where the ore is, which means they're exposed to sudden tax hikes, royalty changes, export rules, and political mood swings. Some management teams also hedge future output, which can smooth the ride, but also mutes the upside when the metal takes off. And finally, there's plain old attention. Big funds often ignore miners until the very last minute because miners are small, complicated, and they require research people don't want to do. add in the fact that mining is capital hungry. When interest rates are high, lenders get picky and equity raises get painful. On top of that, many institutions have ESG restrictions that push them away from extractive industries. And when broad equity markets wobble, miners get sold as risk, even if the metal is acting defensive that day. All of that is real. It matters. But here's the problem. Even after you account for all of that, the magnitude of the disconnect still looks unnatural. Because if silver is up a huge amount over the last stretch, and the miners, who are literally selling silver, are up less, what does that imply? It implies the market is either pricing in something ugly that hasn't been admitted yet, or someone is leaning on the shares. And that's where this gets interesting. I asked him, if it's not just normal fear, what's the mechanism? How would anyone lean on mining shares in a way that keeps them from reflecting the metal? He said there are multiple ways. Some are blunt, some are subtle. You can pressure the ETFs that hold the miners. You can flood the market with shares through shorting. You can use derivatives tied to mining indexes. You can create selling at the open when liquidity is thin, so the tape looks weak and triggers more selling. And here's the key. You don't have to win forever. You just have to delay. Delay keeps the crowd confused. Delay keeps the mainstream investor from realizing what's happening. Delay buys time. Now, at this point in the conversation, I interrupted him for a second because I could already hear the comments. John, aren't you just making excuses for why your favorite stocks aren't mooning? Fair question. So here's my answer. I don't need miners to moon for me to tell you the setup is unusual. The setup is unusual whether you love miners or hate them. It's unusual because in most periods where metals go vertical, miners eventually get pulled upward by one of two forces, greed or math. Greed because people want leverage, math because earnings hit and the market can't ignore it forever. And right now the math should be getting loud, based on recently published numbers from the industry. A lot of primary silver producers have all-in costs that are nowhere near the current price of silver. That spread, price minus cost, is margin. And margin, when it shows up on financial statements, usually drags stock prices with it, whether investors like it or not. So I pushed again. I said, is this possibly a gift? If miners are being held down while the metal runs, does that make miners the better value play? He laughed and said, that's the twist, isn't it? Because yes, if you're a contrarian, this is exactly the kind of environment where value gets created. When something that should be expensive is cheap and it stays cheap long enough that people get disgusted and stop paying attention, the eventual snapback can be violent. But he also warned me, the timing is the trap. The market can stay irrational longer than you can stay emotionally calm. And if you go all in on miners expecting an immediate catch-up, you might spend weeks or months feeling like an idiot, even if you're ultimately right. So what's the practical move? He said he'd split exposure, some in the metal, some in the miners, because if the miners finally break free, they can move fast. But if they don't, you're still riding the core trend through the metal. And I want to add something here. There's a psychological advantage to that split. When you own only miners and they underperform, you start doubting the thesis. When you own only the metal, you might miss the leverage phase if it hits suddenly. A balanced approach keeps you from getting shaken out right before the payoff. Here's what I think could flip the switch, and I'm going to say it plainly. It's not going to be a speech, it's not going to be a viral tweet, it's going to be a boring headline, earnings and cash. When miners start reporting results that are too strong to ignore, when they start talking about dividends, buybacks, debt payoff, and expanding reserves, the generalist money that has been treating this sector like a sideshow will suddenly sniff opportunity. And the moment that money arrives, the one-for-one problem can vanish in a week, because the market doesn't reprice gradually when it's under-owned, it reprices and bursts. First it punishes you with boredom, then it rewards you with speed. So if you're waiting for a polite invitation, you're probably going to miss the opening minutes of the move. That's why I want you thinking now, not later, about what your plan is if you wake up and the miners are up big before breakfast. Do you chase? Do you freeze? Do you take profits? Do you add? You don't have to answer me out loud, but you should answer it to yourself, because when the market starts moving fast, the only people who look calm are the people who already decided what they'll do. Now here's where the conversation got even spicier, because I asked him to zoom out from price charts and talk about the physical market, the pipes, the warehouses, the places where metal is supposed to exist, not just trade, and this is the part most people never look at. He told me to stop obsessing over headlines and start watching inventory. He said, if you want the truth, watch what leaves, And what's leaving right now is not small. And let's talk about supply for a second, because people throw around the word shortage like it's a meme. A real shortage isn't the store ran out of coins. A real shortage is when industrial users can't get reliable delivery at a predictable premium, and they start locking up supply upstream. Silver supply is weird because a big chunk of it doesn't come from silver mines. It comes as a side product of other mining. That means if copper miners cut production because the economy slows, silver supply can drop even if silver demand is rising. That's a supply problem you can't fix by yelling, drill, baby, drill. Recycling helps, but it has limits. A lot of silver is used in tiny amounts across millions of devices. Getting it back is expensive, slow, and sometimes not worth it. So even when price rises, recycling doesn't instantly flood the market with fresh ounces. Now layer on demand that isn't optional. If you're manufacturing electronics, you can't just substitute your way out overnight without redesigns, certifications, and reliability testing. Some substitution happens at the margins, sure, but it's not like swapping brands of cereal. So when my guest says metal is leaving vaults even as price rises, one possible explanation is simple. The physical market is paying up behind the scenes. The easiest available pool of metal is the metal sitting inside investment vehicles that allow redemption. That's when you get the surreal situation where investors think they're adding exposure, but the physical metal is quietly being removed through the back door. And here's another layer that doesn't get talked about enough. Trust. Commodity markets run on trust. Trust that a warehouse receipt is good. Trust that a contract can be delivered. Trust that rules won't change mid-game. When trust is strong, paper can represent metal just fine. When trust weakens, everyone wants the real thing. And that shift from paper comfort to physical urgency is exactly what creates discontinuous moves. It's not just buying, it's the fear of being last. So if you've been watching silver and thinking, this is already a big move, surely the easy money's gone, I want you to hold that thought. Big moves can still be early moves if the underlying imbalance is still growing. The move is not the story, the availability is the story. And the reason I'm emphasizing this is because in commodities, the most violent price action usually happens near the end of denial, not the end of the trend. People deny the shortage. Then they debate it. Then they panic. We're not at the panic stage yet, but we might be closer than most people realize. On the main American futures exchange, a staggering amount of silver has been moving out since the start of the year. Physical metal leaving the system, not just shifting numbers on a screen, and it's not just there. Across major funds that claim to hold silver, across custodial pools, across the vehicles people treat like easy ownership. There's been heavy bleeding, metal exiting again and again. Now pause for a second and let that sink in, because the common sense expectation is the opposite. When price rises, you'd think metal flows in, people pile in, funds get bigger, inventory grows because demand is hot. But we're seeing the weird movie version where the price is rising. The shelves are getting emptier. So I asked him, how does that make any sense? He said, it only makes sense if the metal is being pulled for delivery somewhere else. Think about it. If premiums in certain places are high enough, and if industrial users are desperate enough, then metal gets siphoned out of these vehicles and moved to wherever the real demand is. That can happen through redemptions. It can happen through arbitrage. It can happen through quiet deals that never make the news. And if that's happening while price is rising, you're watching a tug of war between paper claims and physical need. Now there's another piece of plumbing that matters here, short interest in the big silver funds. He explained it like this. When people short shares of a fund, they create extra claims on the underlying metal. But those extra claims aren't necessarily backed the way the marketing brochure implies. It's like selling tickets to a concert where not every ticket guarantees a seat. Most days that doesn't matter because not everyone shows up at once. But in a panic, when everyone wants delivery or everyone wants exposure at the same time, that's when it matters. He told me the short interest in one of the largest silver-backed vehicles is enormous. Not a little elevated, enormous. And if the rules were applied in the strictest possible way, if every share had to be fully backed without exception, the amount of metal required would be uncomfortable, and by uncomfortable, I mean price changing. Now, I'm not saying tomorrow morning the system snaps. I'm not saying the world ends at breakfast. I'm saying the structure is tight. And tight structures don't relax gently. They either get relieved slowly through new supply or they pop. So I asked him, what about the miners again? If physical is tight, shouldn't investors be stampeding into miners for supply exposure? He said that's the logical trade. Yes, And he also said that is why this disconnect feels like someone is trying to keep the stampede from starting. Because once the stampede starts, it's hard to stop. Here is the part where I want you to really pay attention, because this is where we go from interesting to potentially historic. The silver market is not just a jewelry story, and it's not just a coin collector story. Silver is a working metal. It's used up. It gets built into things. It gets scattered into tiny amounts inside products. And then it's not economically recoverable. That means above ground supply isn't a static pile. It's a pile with holes in it. And based on the latest publicly available filings and industry surveys, global silver demand has been running ahead of supply for multiple years in a row. That's not a one-off. That's a trend. And trends, when they run long enough, create pressure that doesn't show up in price until suddenly it does. Now add the industrial side: solar panels, electronics, data centers, power grid upgrades, electric vehicles, medical devices. Silver is everywhere in modern infrastructure, and a lot of those sectors are not slowing down. If anything, they're being pushed by policy, by investment, and by consumer demand. So when people say silver is volatile, I agree. But volatility cuts both ways, and the more essential the metal becomes, the more the volatility can become one-sided when supply gets tight. This is where my guest used a phrase that I won't forget. He said, "We're walking toward a wall, we just don't know which step hits it." That's it. That's the whole game. You can't time the exact day the wall shows up, because markets can pretend for a long time. They can stretch, they can distort, they can create paper substitutes. They can cash settle. They can change rules, but they can't manufacture metal out of thin air. So I asked him the question that everybody wants answered. Do you really think we could wake up and see silver at a price that sounds insane today? He said yes, not because he's trying to sell you a dream, but because discontinuous moves happen when a market is tight and the shorts can't exit smoothly. If you have a huge short position and the market goes against you, you normally buy your way out over time. But what if there isn't enough liquidity? What if the physical market is too tight and the paper market starts doubting itself? That's when you don't get a gentle curve, you get a gap. A gap is the market admitting it was lying. And the reason this scares people is because a gap doesn't give you time to think, it forces you to react. It forces institutions to rebalance, it forces margin calls, it forces headlines, it forces politics. Now, right here, I'm going to ask you a question, and I want you to answer it in the comments. If silver gaps up overnight, no warning, no gradual climb, are you positioned in a way that helps you? Or are you positioned in a way that hurts you? And be honest, because honesty is how you get better. Also, if you're successful, share your success story in the comments so others can stay motivated. People underestimate how much a single real story can keep somebody from quitting. Now, before we go into the what could they do about it section, I want to address something I don't fully agree with from the competitor-style narrative you may have heard elsewhere. A lot of people jump straight to, it's all manipulation. That's the whole explanation. I think that's incomplete. Yes, markets can be managed. Yes, games get played. But if you blame every weird move on a shadowy hand, you miss practical realities that can hit miners specifically. For example, miners don't just mine silver. Many of them are actually byproduct producers. Their silver comes out alongside other metals. That means their fortunes can be tied to base metal demand and local smelting capacity. If there's a bottleneck in refining, that can affect realized prices and shipment timing. Also, miners often have to invest heavily to grow production, and growth spending can temporarily crush free cash flow even when the metal price is high. Investors can sniff that out and refuse to pay up. So yes, there may be pressure, but there may also be real-world friction, and here's why that matters. Because if the underperformance is partly structural, the catch-up may not be perfectly clean. You may get a selective explosion where the best-run companies rocket while the sloppy ones lag. That's not a reason to ignore miners. It's a reason to be picky. Now back to the what could they do about it question. Because once the market hits that wall, the response may not be polite. My guest and I talked about the ugly possibilities people whisper about: confiscation, export restrictions, windfall taxes, forced cash settlements, new reporting rules that make owning certain assets more complicated. Do I know that any of that will happen? No. But I also don't dismiss it as fantasy, because when something becomes strategically important, when governments see it as tied to defense, energy security, or industrial independence, policy gets weird. In recent market updates, you can already see countries talking more openly about securing critical materials. That's not just about obscure metals, it's about anything essential to advanced manufacturing. So if silver becomes perceived as a choke point, don't be shocked if governments start acting like it. And here's the cliffhanger. The very policies meant to stabilize a market can be the thing that accelerates the panic. Because once people think rules could change, they rush to act before the change. That's how shortages become stampedes. Now let me bring this back to something practical you can watch without needing insider access. Watch the relationship between metal price action and miner price action. If we get a day where silver rises strongly and miners finally respond with real strength, broad strength, not just one or two names, that could be your signal that the handcuffs are slipping. And if the handcuffs slip, it can happen fast, because the miners are thin compared to the metal market, they're smaller, they're more liquid. When big money decides it wants exposure, it can't tiptoe, it has to push, and that push can turn into a feedback loop. Price rises, momentum traders notice, inflows hit, shorts cover, price rises more, that's the loop. So I asked him, what breaks first? The shorts or the patience of investors? He said, usually the shorts' patience can last, margin calls can't. If you're short into a rising market, your losses are theoretically unlimited. And if the move gets violent, you don't get to debate philosophy, you get a call from your risk department. Now let's talk about the East versus West angle without turning this into a political rant. There is a real shift happening globally where countries want more control over supply chains. They want local processing, they want to hold more hard assets, they want to reduce dependence on rival systems. In that environment, physical metal matters more than paper promises. So even if a futures market quotes a price, the real question becomes, can you actually source the metal at that price and size? That's the question industrial buyers ask. And if the answer becomes no, then paper prices stop being the anchor. They become the advertisement. Now you might be thinking, John, this is all intense. What am I supposed to do with it? Here's what you can do, even if you're brand new. Educate yourself on the difference between paper exposure and physical tightness. Understand that not every product that tracks silver is the same in a stress event. Don't ignore miners just because they've been disappointing. Disappointing setups are where the biggest surprise moves come from. Stay flexible. Don't fall in love with a single narrative. Markets punish certainty, and keep your eyes on the signals, not the noise. If inventories keep draining while price climbs, that's not noise. If miner leverage stays missing while margins expand, that's not noise. If short interest stays bloated while physical demand stays firm, that's not noise. Those are signals. Now I want to give you a quick heads up about something we offer, because it fits perfectly with today's topic. We have members-only videos that are produced by a separate team with more research, and those deep dives are only for premium members. If you want the more detailed version, more charts, more context, more digging, check the membership join link in the description. And again, there is also a premium WhatsApp channel link down there for people who want updates without having to hunt for them. Alright, back to the story, because we're not done. The competitor-style script you sent talks a lot about how this time is different. And that phrase gets abused. Most of the time when people say this, time is different, it's a top signal. It's the moment before reality slaps them. But in tight commodity markets, different can be real, because the inputs aren't imaginary. Silver isn't a meme token. You can't clone it with code. If demand is structurally higher and supply can't respond fast enough, the market has to do one thing, ration, and rationing happens through price. Now, do I think we go from here to some fantasy number overnight and everyone cheers? No, if there's a discontinuous move, it will come with chaos. It will come with volatility so sharp, it makes normal people swear off markets forever. It will come with sudden rule changes in derivatives markets. It will come with people who thought they owned exposure, realizing they owned a promise. And it will come with the weirdest part of all. The public won't believe it until it's already happened. That's why I'm talking about it now. And if you think this can't happen in a modern market, remember, modern markets move faster, not safer. Liquidity is a mirage when everyone runs to the same door at once without any warning. Not to scare you, to prepare you, because the worst position to be in is confused during a fast market. So let me ask you another question for the comments, and this one matters. Are you more interested in holding the metal itself? Or do you want the leverage of miners, knowing that leverage can cut both ways? Tell me your thinking. I read these comments and they shape what I cover next. And remember, if you're successful, share your success story in the comments so others can stay motivated. The community learns faster when people share what worked and what didn't. Now, there was one more thing my guest said that I want to leave you with because it ties the whole story together. He said, people keep debating price. The real debate is availability. That's the heart of it. If silver stays available, the market can stay orderly. If silver becomes hard to source, the market becomes emotional, and emotional markets don't move in straight lines. They move in leaps. Here's what I'm watching. Metal leaving major vault networks. Signs of strain up front. Leases tightening. Deliveries getting urgent. Buyers paying up for metal now. Miners staying sleepy because the day they surge together is the day the regime flips. Big investors rotating out of paper promises into hard stuff when confidence wobbles, and policy chatter around critical materials because one aggressive rule can turn a slow burn into a sprint. I am also watching the gap between paper quotes and real-world premiums because stress usually shows their first very early. If a couple of these line up, expect fireworks. So if you got value from this video, do me a favor, subscribe, drop a like if you want me to keep covering metals and miners in this high detail style. And share this with a friend who still thinks silver is just a shiny hobby, because the next phase of this story might not be polite. And one last thing, because I have to say it, I'm not telling you what to buy or sell. I'm laying out how I'm thinking about this setup, what signals I'm watching, and why the disconnect between metal and miners is a big blinking light. Use this for education, do your own homework, and make decisions that fit your situation and your risk tolerance.